Hello, everyone. Today is Friday, December 5th, and this is your 314 SMI investor update going into the month of December. Fernando, how are you doing?
Doing okay. So let's talk about RAA and FCT here. We'll start with RAA.
Yep, and November was a choppy month for the markets. Everyone knows that the S&P 500 basically suffered a 5% drawdown, a little bit more than 5%. And those are more or less run-of-the-mill pullbacks for the S&P 500. But under the surface, our research showed that the average stock was down from a 52-week high more than 16%. So when you back out and say, okay, what does that pain under the surface look like? The pain under the surface was uh, more like a 10% correction. So yeah, choppy month, down 5%, nice recovery towards the end of the month. But the pain was real. We saw sentiment reset. I think it gives us a pretty good overall market backdrop going into December because you want to see sentiment come down a little bit going into a positive December. That's your classic setup. So RAA wasn't totally immune from the choppiness, but it still eked out a positive return, positive about just under 20 basis points for the fund. And the drivers here are on this page. We always show this, the individual assets that drove performance and then the asset classes. And so this is an interesting month because you can see gold was a positive driver of returns for the model. Gold miners or metals miners were also a positive driver of returns. Bitcoin was obviously part of this sentiment reset as we saw Bitcoin really get hammered here, down close to 30% or something like that, peak to trough. You've seen Bitcoin subtracted from performance, and so did Nasdaq because Nasdaq's drawdown was more than the S&P 500. And so the bottom line is that gold kept performance from being disastrous, but because of the Bitcoin exposure and the Nasdaq overweight, it wasn't like the model ran away from benchmarks. Now, year to date, we've seen the real asset allocation model, which underlies this fund, the fund having been launched in February. So it doesn't have a full year to date performance profile yet, but the underlying model, which the fund tracks, is up now over 15% year to date. 60/40 is closer to 13.7%. So the model has beaten 60/40 by 140 basis points. And I think that the underperformance was at the beginning of the year before the fund launched, just if anyone's following along at home. And that's really what we want to see. We want to see that this real asset allocation framework, the alternatives, enlarging the menu, using trend following is boosting returns over your standard 60/40 portfolio. And this has been a good year for 60/40, almost 13.7% return for 60/40. Our track of 60/40 is S&P 500, an aggregate bond index, rebalanced monthly. That's a way we compare things every year. We compare the real asset model to that benchmark because it's a domestically focused fund, just as a point of reference. So good year for 60/40, but even better year for real asset allocation model and fund. Turning the page to December, we've seen the model make some interesting moves. The most notable is after having many months of equity overweights, the model took its equity weighting down. So down closer to 41% equity weight. That's beneath the 50% benchmark weighting for equities. And definitely notable is that even NASDAQ is an underweight within that equity sleeve. And NASDAQ's been a significant overweight through this year. So that's notable. Where did the weight go coming out of the equity sleeve? It went into alternatives, specifically really in the commodity complex. It was really spread across the entire alternatives bucket. You still have some Bitcoin weight in there. Commodities are an overweight. Energy is an overweight, which is interesting. We've also seen gold maintain its overweight Precious metals and metals miners maintain an overweight, and managed futures received a decent amount of weighting for the month, which is interesting. And so that's where we went from equity to alternatives, a lot of commodity focus, kind of a value type of focus there. So I wouldn't necessarily characterize the model as having dialed down its overall risk exposure. It's more of just shifting it around. The bond exposure is slightly overweight, very slightly overweight, really close to benchmark weight. Nothing to write home about there. So that's the real asset allocation model performance for November and looking ahead to December. Now let's talk about FCETE, full cycle trend ETF. If you go back, so something we've talked about here is the underperformance of FCTE this year. It's been a sore spot for us. The strategy work has been good. Real asset allocation has been good. All the other models that we track for our service, our 314 research service for clients, have outperformed their benchmark this year, really. But FCT has been a notable sore spot. And so we did a deep dive last month. If you're interested in understanding what our view was of why FCT is underperformed, I would recommend going back and checking that November update out. So the bottom line on that was that we're caught between a quality bear market and equal weight bear market, and a couple other factors. And so that's not to belabor that point, but I would just say go back and watch that video. Now, what happened in the month of November was actually a positive month for FCTE. Nothing to write home about, since October was the worst relative performance month in the model's history, going back decades. And so that was interesting. But we did see a rebound in November, a modest rebound, beating the S&P 500 by 1%, 100 basis points or so. Drivers of returns, you see IDEX was a big driver. Having a lack of tech exposure was a help to FCTE in November. As we play it forward, what was the model buying? Because remember, the way this is set up, it is not a benchmark hugging system. This model is not going to hug the benchmark, which you've seen this year in its performance. It's 20 stocks equally weighted, selected from a quality universe. We're looking for uptrends that are pulling back, uptrends within that quality universe that then pull back. And that's where this model allocates. That's the system that underlies this ETF, and that we believe over time provides it a valuable exposure and diversifier for portfolios. And it did go in the spirit of that system. It did go in and buy a lot of the tech quality dip that we saw in November. So new additions to the fund this month included stocks like NVIDIA and KLAC and Arista and Microsoft, maintaining position in Meta, maintaining position in Oracle. So we went from a very low tech exposure to a pretty high tech AI exposure going into the end of the year. We'll see how that works out. But so far, the month of December has been a good one for FCT. Hopefully, it's building a nice solid base to end the year and going ahead into 2026, because many of the stocks that come out of this quality universe, we believe, are going to have to be those early adopters of AI. If AI is going to gain traction in the economy, it should show up in this universe. So we're looking ahead to 2026 and shrugging off the horrible 2025 performance that we've seen so far. Fernando, you have anything to add here?
I think that's a good place to wrap up here.
Okay. Maybe scroll down. Well, we appreciate everybody out there watching. Until next time, next month, I guess that'll be in the new year. Have a happy new year, happy holidays, and appreciate you watching.